So welcome to this video. In this video, we are going to discuss about working capital management. So we'll start with an introduction to working capital. Working capital is the capital available for conducting the day-to-day operations of an organization. In a company, we should always maintain liquid assets. So what is a liquid asset? Any asset that can be converted into cash within 1 year. What are those assets? That assets can be like inventory, receivables, cash, bank. Okay, so these are the liquid assets that can be converted into cash within a year. Similar to liquid assets, a company also has liquid liabilities. Liquid liabilities are payable within 1 year. So what can be a liquid liabilities? Liquid liabilities can be a short-term bank loan, or it can be a bank OD, it can be a payables, or it can be a outstanding expense. So these are referred to as liquid liabilities. So why should we have liquid assets and liquid liabilities? See, liquid liabilities represents an expense that can be asked by the creditors whenever they want. So what happens is the company should have sufficient amount of liquid assets to pay the liquid liabilities whenever they want the due. So why should we pay liquid liabilities on time? Because only when you pay the liquid liabilities on time, it helps the company to have a good name, a good reputation, and a good standing in the business community. Because whenever the company wants a bank OD or a bank loan or a payables, then only these parties will be ready to give us these kinds of instruments or help. So a company should always have sufficient amount of current assets, to repay the current liabilities. Okay, so the current assets, that's why it should be more than the current liability. Normally, the excess of current assets over the current liability is the working capital. So we can call this as working capital, or it's also referred as net working capital. Current assets include inventory, receivables, cash, bank, short-term investments. Current liabilities include overdraft, payables, short-term loan. Working capital management is the management of all aspects of both current assets and the current liabilities to minimize the risk of insolvency while maximizing the return on assets. So working capital management is a trade-off between the liquidity and profitability. So we look at the objectives of working capital management. The main objective of working capital management is to get the balance of current assets and current liabilities right. This can also be seen as a trade-off between the cash flows and profits. Current assets are a major financial position statement item and especially significant to smaller firms. So current assets are a huge amount of number for a small firms, and it is also a significant number for large firms also. So the mismanagement of working capital is therefore a common cause of business failure. So if the company is not going to get the working capital right, then there's a high chance of the business failing. So why is it so? So there can be like various expenses like electricity bill or salary or payables. These might become due in over a period of time. The company should have sufficient amount of liquid assets or current assets to pay these bills as they rise. If they are not able to pay, what would happen? If they are not able to pay, these people, okay, these stakeholders can file a case on you. They can go to the court So that might lead to a lot of problems. And there's also a chance that if you're not going to pay for a longer time, then these stakeholders, these current liabilities people can make your company to shut down also. For example, inability to meet bills as they fall due, demands on cash during periods of growth being too great, and overstocking. So the company should ensure that they don't do any of these things, okay, because the working capital has to manage in a very proper way. So we look at what is the investing in working capital. This is a very important part of a question. So ensure that you understand this concept. So investing in working capital is always a trade-off between the liquidity and profitability. So what is liquidity? Ensuring current assets are sufficiently liquid to minimize the risk of insolvency. So the company should have sufficient amount of current asset. So for example, the company should have a high amount of inventory, a high amount of receivable, a high amount of cash. So that is what is called as liquidity. But investing in less liquid assets in order to maximize return. See, if a company is going to invest in an inventory, it is not going to generate much profit. Or if a company is going to have more amount of receivables or cash, it's not going to give a high amount of profitability to the company because the money is tied up with these assets. Money is tied up with these assets. So it is not being used in a productive way. So that's what profitability says, that have inventory, receivable and cash at the lowest level possible. So when you have a low level of inventory, receivable, cash, what happens is the money is free and not locked up. So the money is not locked up in any asset, and this money can be invested. It can be invested in business. So you can invest this in a business and make more profit. For example, you can invest in a new machinery, repay any long-term loans. So the money can be freed up and it can be used for some profitable activity. So we have seen that a company should invest in their working capital, but the question is how much net current asset, that is CA minus CL, are to be held by a company, because this is called as the investing in working capital. So essentially, as we have seen, it is only a trade-off between the liquidity and profitability. So liquidity refers to having invested cash in current assets. So you put more amount of your cash on your investments in current assets. Profitability is having invested cash in fixed assets or in investments, or it can also be or reducing long-term finance. So you repay your equity or you repay your loans. So either way, the money is being put to a profitable use. How much of working capital we can have? So that is what is being dealt here. There are like two approaches here. So one is called as a conservative policy and the other is called as a aggressive policy. In conservative policy, they state that there should be a high amount of working capital because high CA, low CL. That is what their concept is. Have more amount of receivable, inventory and cash, okay, and have less amount of OD, payables, etc. Okay, so that is what they are trying to do. Have more current asset, have less current liability. What would this do? This leads to a high liquidity. For example, it leads to more raw materials, work in progress, finished stock and receivables. And it also leads to low profitability because more money is tied up in these current assets. So more cash tied up as working capital, thus being unproductive. So we could look at the second policy. It's called as aggressive policy, which leads to low working capital. So low working capital is equal to low current asset and high amount of current liability. So this leads to low liquidity. So the company has less raw material, work in progress, finished good, receivables, or even cash or bank and this leads to high profitability because less cash is tied up as working capital, and thus the cash is put to a productive use. So again, which is the best approach? The approach depends upon the company. So if the company wants to take a aggressive stance, then they can go for aggressive policy. If the company doesn't want to take too much risk, they can go for conservative policy. So we have a quiz. Which of the following statements concerning working capital management are correct? The twin objectives of working capital management are profitability and liquidity. The answer is yes. A conservative approach to working capital investment will increase profitability. No, it will decrease profitability. So this option is wrong. Working capital management is a key factor in a company's long-term success. So even though we see that working capital is a short-term management of capital, but only when a company gets this right, the success of the company is ensured. So this is a right choice. So the answer is 1 and 3 are correct. 1 and 3 refers to B. Let's see the option. The option is B. So we look at what are the factors which are affecting the working capital of a company. So there are like several factors which affect the working capital of a company. So the first one is nature of business. So it depends upon your nature of business, which leads to how much of working capital you should have. We can have an example like this. We'll assume that you are a bike manufacturing company. You should have high amount of inventory. You should have high amount of inventory because there are like many models and there are like many showrooms, so you have to stock all the showrooms and all with all the models, so inventory will be high. The raw material and also will be high because all raw materials are required to produce one single bike. Okay, so again raw materials will be high. The company will might also sell the goods on credit, so the receivables will be high. So what happens is this company's capital, working capital, will be much more higher. So this next one we'll discuss about service business. So service business, we can have it like an IT company. So in an IT company, what are the inventory that they have? See, the inventory that they have is like computers, but even computers are a fixed asset. So any other inventory they have? No, they don't have much of inventory. They might have softwares. Again, softwares are stocks, so they might not have much inventory, and they might not sell things on credit, they might sell only on cash. So if you usually take, their working capital will be usually lower, and the working capital for manufacturing companies will usually be higher. Okay, so this is about the nature of business. So now we look about the business cycle. We'll put it like this. Normally the demand for any product will be like wavering in nature. For example, we'll take a product like two-wheeler bikes. From January to December, there are like 4 festivals which come in equal distance. Okay, one you get it on April, the other one you get it on something like July, the other one you get it on September. What happens in festival season is the people will be like willing to buy more uh, products, so they might be willing to buy a bike also. So the sales will be high during festive seasons, and the sales will be low during normal seasons. So if you take, the sales would be like fluctuating from the like this. Okay, so inventory are required at this level, and the inventory is like lessly required at these levels. So it is also the business cycle which determines how much of working capital you can have. So it differs from business to business, but all businesses are affected by the business cycle. So the next one is called as seasonal factors. So some, you can take seasonal factors items like raincoats or ice creams So these are items which are like usually affected by the season. So this in the rainy season you have more demand, and this you have demand in the summer season. So seasonal factors affect the level of working capital a company has. Or production cycle, some products take a long time to produce. They take a long time to produce. Okay, for example, building construction company. Okay, so these companies usually have a high amount of working capital, but there are companies which have also a very short term cycle. For example, like biscuit manufacturers, so they can quickly do it within a week's time and they can also sell it. So biscuit manufacturers or chocolate manufacturers, these guys, even though they are manufacturer, their production cycle time is like very less. And for companies like building construction or dam construction or road construction, for them they will have a high level of working capital. So credit allowed and credit availed can also affect. If you're going to make high amount of credit sales, then you should have working capital as high. But if you're going to avail credit, so if you're going to purchase all the items on credit, if that is going to be high, then your working capital is like low, because your working capital is funded with the current liabilities. So that is how these things are interrelated. So it also about the operating efficiency. So if you have high operating efficiency, then you will be ending up with low working capital, and the vice versa is also true. Growth prospects, if you are a company which is like keep on growing very fastly, then you should produce more items, then you will have more, you have to buy more raw materials, you will make more sales, and you also have to do a lot of credit sales. So a company which has high growth speed will also have high working capital. So level of competition, if the level of competition is higher, again your working capital will be higher. So why is it so? Assume that you are a monopoly. If you are a monopoly and you are a bike manufacturer, you can just sell one model of motorbike in the market. But if the competition is going to be severe, then you have to launch several variety of motorbikes. For example, 10 models of motorbikes. So if you're a monopoly, you can just sell one bike and you can make people happy. But if you have competition, you have to sell a lot of variety of motorcycles. Inflation, the higher the inflation, higher the requirement for working capital. So why is it so? Because the cost of raw materials, the cost of work in progress, the cost of salary, everything goes up year on year, and that leads to increase in working capital. And the last is availability of raw material. If raw materials are easily or highly available, then your working capital can be less because you can buy whenever you want. But if availability of raw material is like not available all times, okay, only seasonally it's available. For example, like orange fruits. So orange fruits are not available in all the season. It's only available in a particular season. In that case, the company has to stock a lot of oranges. So their working capital goes up. So these are the factors which affect the working capital of a business. So we look at a common assumption in the work financing of working capital. So this is something is like very important. So in exams, they always ask you either of questions like investing in working capital that we saw earlier and about financing the working capital that we are going to see now. So there are certain assumptions in this financing working capital. The first one is to finance the working capital, you can do it through short-term finance, and the assumption works like this. Short-term finance are very cheap to arrange. So whenever you want, you can quickly raise OD, or you can quickly get a bank loan, or you can get a bank loan. But they're also very flexible. Whenever you want, you can get it. When you can borrow whenever you want, you can also repay whenever you want. But the problem is it is risky and volatile. So why is it like risky? Assume that the cost of short-term finance usually goes up and down and up and down. So you never know like when Assume that you want at this point of time the interest might be higher, so you can never predict like where the rate will be keep moving. So they're always risky and volatile. So the opposite is long-term finance. So long-term finance are very expensive because like arrangement fee is high. For example, like preliminary expenses, you issue a debenture, you have to pay legal fees, you have to appoint merchant bankers. So there are like problems here, and it is also inflexible. You cannot like borrow a debenture and pay it like in 1 week and all. So it is like you have to take it has a long-term approach. So it is inflexible, cannot be borrowed, and you can't like pay it whenever you want and all. That's a problem. But the good thing is it is stable. For example, you issue a debenture. The debenture is a 7-year debenture at 10% interest you are going to give. So this 10% is going to be stable for the next 7 years. Okay. So we'll compare short-term finance and long-term finance. Short-term finance are very cheap because in the terms of arrangement, it's cheap. But long-term finance are expensive. Arrangement fees is higher. It's more short-term finance are flexible. Whenever you want, get it, pay it. Long-term finance, not like that. You once you got it, you have to be with it for a long time. Short-term finance are risky. It goes up and down, up and down, and up and down. And this is actually within a 1 year. Okay, within 1 year itself, they're like very volatile. So they can reach a high of like 15. They can also go to a low of 5. But long-term finance are stable because you have launched one debenture for 7 years at 10%. So ensure that you understand these assumptions perfectly. So we'll see what is a permanent working capital. It refers to the minimum amount of all current asset that is required at all times to ensure a minimum level of uninterrupted business operation. That is a part of working capital that you should always have in business. So something like constant level of inventory, receivables, cash that you should always have. Some minimum level of raw materials, work in progress, bank balance, finished goods, etc. For a growing business, the permanent capital, working capital, will be rising. For a declining business, it will be decreasing, and for a stable business, it can remain stable. This part of a working capital, being a permanent investment, needs to be financed through long-term funds. So this is an important consideration. So we look at the temporary or varying working capital. It varies with the volume of operation. It fluctuates with the scale of operation. This additional working capital required during peak seasons over the above fixed working capital. So temporary working capital is above the permanent working capital. During seasons, more production or sales take place, resulting in larger working capital needs. Temporary working capital can be financed through short-term funds, that is current liabilities. When the level of temporary working capital moved up, the business might use short-term funds, and when the level of temporary working capital recedes, the business might retire its short-term loans. So we'll look at this from a picture. So you can have it like this. These are the total amount of assets a company has, and this is over a period of time. So we can put it as like years. Okay. So that is a fixed asset, like what we know, and these are the total working capital. So working capital is split into two parts. One is called as a permanent working capital, and the other one is a temporary working capital. So you might see here the temporary working capital keeps fluctuating. At one point it's higher, at one point it touches the permanent working capital, again it goes up, again it touches the permanent working capital. So that's why it is called as a fluctuating or temporary working capital. So we look at the financing of the working capital. The first approach is called as a matching approach. So the matching approach works like this. The matching approach says that the fixed assets and the permanent part of the fixed assets have to be like funded through long-term funds. So this is long-term fund. This is also long-term fund. But the temporary current asset is like financed through short-term fund. So that is about matching approach. We have next approach called as the conservative approach. So in conservative approach, they say that the fixed assets, the current assets, okay, the permanent part of the current asset are like long-term funds, and this is also long-term funds. But within the fluctuating current assets, okay, a part of it is also funded by long-term funds. Another part alone is like funded through short-term funds. That is, this company is favoring the long-term funds. Why? Because they are a conservative company. What are the features of a long-term fund? They're expensive in arranging, so that's a bad thing. They're inflexible. They're also inflexible. Again, that's a bad thing. But they are stable. But they're a stable source of fund. So the company favors more stability, and it is like trading off the expensiveness in arrangement and inflexibility in repaying. Okay. So that is what the conservative approach is all about. So we look at the aggressive approach. So this says the fixed working capital is used long-term funds. A part of the permanent capital alone is like given with long-term funds. Another part of the permanent current assets is like used with short-term funds, and the entire fluctuating current asset is used with the short-term fund. So this company is favoring short-term funds because short-term funds are cheap, short-term funds are easy to arrange and easy to pay, so they are like very flexible, but they are very risky. So this company is like aggressive. They want the cheapness and the flexibility, but willing to take a risk. So that's why they are using this kind of a method. So here we look at the ratio. We'll start with the cash operating cycle. So what is the cash operating cycle? Cash operating cycle is the difference between the days of cash invested in current asset and the cash received from current asset. Okay, so cash operating cycle tells you like what is the difference between the day in which the current asset, the cash has been like invested in the current asset, and the day on which the cash has been received from the current asset. So cash has been invested in terms of the raw materials, in terms of work in progress, in terms of finished goods. This is finished goods being stored in your company, and the goods which have been sold on credit, and deducting the paying the creditors. That is the short term, that is the payables that we got from our creditors. Okay, so add all the days of raw material, add the days of work in progress, add the days of finished goods in your godown, add the days of credit sales, deduct the payable days, you get the cash operating cycle. So the lower the cash operating cycle, the better it is for the company. So that is good for the company. So we look at the formulas here. So inventory holding period lets you know that the length of time inventory is held between the purchase and sale. So the answer is the lower is the better. Raw material inventory holding period lets you the length of time raw materials are held between the purchase and being used in production. Again, lower is the better. Work in progress holding period, the inventory length of time the goods spent in production. Again, lower is better. Finished goods inventory period, the length of time finished goods are held between the completion or purchase and sale. So again, the lower is better. Trade receivable days, the length of time credit is extended to customers, lower is better. Trade payable days, the average period of credit extended by suppliers, this alone, the higher it is, better. So while doing these formulas, we have to understand that there are some notes. For example, if the question requires you to calculate operating cycle in days, then use 365 in the ratio. If it asks for weeks, use 52. And if it asks for months, use 12. Also be cautious. Sometimes question tells you to assume there are 360 days in a year, okay, or 50 weeks in a year. Then use those numbers. Do not use the 365 and 52 and all. So there are also additional notes. If question requires you to calculate a ratio for a single period and gives opening and closing value, then use average value for inventory, receivable, payables, that is opening and closing value. For example, the question gives you data for 2019 and 2020. So the question gives you data for both and asks you to calculate for the 2020 alone. Okay, in that terms, what you'll do, in that terms, you take this as the opening number, this as the closing number, you take an average. Okay, so that will give you the inventory average, the receivable average, and the payable average. If the question requires you to calculate a ratio for two periods and gives opening and the closing value, then use the respective value for inventory, receivable, and payables. For example, again, assume that the question gives you 2019 data and 2020 data. So data is available for both, but they ask you to calculate the ratios for both the years. In that terms, what you'll do, in that terms, you don't take an average. You don't take average and all. Rather, you take that year data and compute the ratios. Okay. So you compute 2019 data. You take the 2019 data and compute the ratio for 2019. You take the 2020 data and you compute the 2020 ratio. So that is how you have to work it out. To know whether the operating cycle is better or worse, compare it with previous year or industry or competitor. So we discussed in the formulas that certain ratios are higher the better and lower the better. But you can't say that something like higher is better or lower is better. You have to compare it with the previous year of the company's operation or with the industry-wise average or with the competitor. Usually this will be given in the question itself. Okay, so ensure that you do this with ask. So we look at the ratio analysis for liquidity. So current ratio, it is measured in a ratio. You have to compare with the others to find out if it's better or not. It indicates the short-term liquidity. Again, you have quick ratio or asset test ratio. It's measured in ratio. You compare with others. It indicates very short-term liquidity. Position. So inventory days and receivable days and payable days we have already seen. We have also already seen the cash conversion cycle also. So we look at a very important ratio. This ratio is called as working capital turnover ratio. The formula works like this: net sales divided by average net working capital. It's expressed in times. The higher it is, the better. It indicates how well the working capital is utilized. Again, higher is the better. It also you have to compare with the suitable comparator like previous year or industry average or the competitor data. So you have to compare with these and then tell whether it's better or not. We have a quiz. Which of the following transactions would increase the current ratio and decrease the net profit? Whenever you have these kinds of increase in current ratio or decrease in current ratio, it is better that you write and work out the current ratio. So we'll start with the first option. Tax due from the previous year is paid. So we'll assume some number. So current asset is 120, current liability is 100. So the ratio is 1.2. What would happen if the tax is paid? Assume that the tax is something like 20 rupees. So 120 minus 20, because cash is paid, so 20 will move off. The tax is a liability, so you deduct here from 20. So you get an answer like 100 divided by 80. Your number is moving to 1.25. So will it be like correct to say that it has moved? Is it increasing the current ratio? Yes, current ratio gets increased. Does it decrease the net profit? It does not decrease the net profit, because the tax due would have been already deducted in the previous year. So this year's net profit does not get deducted. So this is not the answer. So the next option is share purchase. So if you purchase share, your current asset would go down. Okay. So if your current asset goes down, it will only decrease the current ratio. So this is not the answer. So we look at the scrip dividend. Scrip dividend is paid. So if you pay a scrip dividend, it does not affect your current asset nor your current liability. So this is not the choice. So the choice should obviously be D. But still we'll work out D. Machine is sold for less than the net book value. So machine is a fixed asset, so it will not affect our current asset. But when we sell it, our current asset will increase. For example, if you take that machine worth is something like 80 rupees, our numerator will become 200. So 200 by 100, it will give us 2. So this part of the question is correct. But will it decrease our net profit? See, machine is sold for less than the book value. So if the book value is 100 and if it is sold for 80, okay, that is what is the 80 that we have marked it here. It means it is a loss. You're going to sell 100 worth of assets for 80. You're going to incur a loss. So that would decrease your net profit. So this is the right option. So the option should be D, and the option is D. So we have another quiz. The company has a current ratio of 1.5. The company has cash surplus and has decided to pay its trade payables after 20 days in future rather than 40 days as it has in the past. How this will affect the company's current ratio and working capital cycle? So we'll work out like this. So we'll start with current ratio. Current ratio is CA by CL. So we'll take current asset as 120 and current liabilities as 100. So the answer comes to 1.2. So what he says surplus cash is being repaid. So we'll assume that the surplus cash is 20 rupees and they have paid the payables of 20 rupees. The answer comes to 100 divided by 80. So the answer comes to 1.25. So if they do this, they are paying the trade receivables with surplus cash, that will increase the current ratio from 1.2 to 1.25. So current ratio will increase. So A and B can be the choice. So the operating cycle works like this: inventory plus receivable minus payable days. So this is the operating cycle days. We'll assume some days for operating cycle. For example, we take 100 as for inventory, some 20 for receivable days, and minus 40 because the earlier payable days was 40. You'll see the answer. The answer comes to 80 days. So the new policy is, let this be 100, this also be 20, but the new payable days is going to be 20. So the answer comes to 100. Okay. So there is an increase in the operating cycle days. So it is an increase. So option A and C are being chosen here. But among these, this is the only one which is like both the options are right. So answer should be A. So we got the answer. So if you get a question like this, you have to assume some numbers, okay, and you have to work out. But assumption should not be in all the numbers, because if he has given you certain numbers like here, here, and here, you have to use them and solve it. So it's all about practice makes perfect.